Okay, so this morning we are going to talk about different types of paid tax preparers to kind of give you a frame of reference, and then we'll talk about some various what I call selected topics, both federal and state, and then we're going to go into a total of two tax returns, and one, of course, is a married filing joint with the Walters, and the other one will be a head of household with Maria Adams. And then, of course, if you have questions from the attendees, we'll definitely take those today. Our session is going to go to noon. We'll take breaks at about 10 o'clock and about 11 o'clock. Okay, so once again, it's always good to know the cast of characters, so to speak. And so if you're new or newer to St. Killian's, your cast of characters is long. You want to focus in on Robert Andrews. He's the guy who's going to be coordinating. You've got Mel, he'll also be coordinating, and then you've got the other players. You've got a great IT staff there, and then of course led by our emeritus, Fred Ramos. He's been with the program many years. And then do keep in mind your IRS representative, known as a tax consultant, that's an employee of the IRS. She'll be either dropping in or assisting the program as needed. And her name is Christine Gallardo. Okay, so I was focusing on references because anything that you do in the tax world, there's no way you're going to have all of this in your mind. It's just not possible. The tax world is a very large place, and so we know our go-to document is going to be that publication 4012, and I recommend that you get a hard copy. Those are available. At least they were available at the church office. And it's a great document. It's going to walk you through just about all of the things you need to know on the federal side of the house, to include navigating through the tax preparation software. And then keep in mind that tax preparation software that you're going to use, it's going to look very similar to the practice lab. And that's the whole purpose behind the practice lab, to replicate what you're going to see in real life with live taxpayers, if you will. And then for the California return, you got a number of references to include the what is called the Volunteer Reference Manual, and that's the publication 5130 from the state of California. And that's also been published. It's on the street. Very helpful document as far as tax preparation. And then just a couple other things. A lot of times you'll have questions regarding dependents. There's a number of publications to include the publication 501. That's an IRS publication. And then as far as the state of California, you've got that site map that we talked about. And that site map, I actually use that in my practice. It is a very useful landing page, if you will. It is packed with information to include income deductions and credits for the state of California. And it's been updated, about a month and a half ago, 2 months ago, I guess. And then other publications, we talked about this, and you probably won't spend a lot of time in these publications, but they're definitely worth knowing. We talked about the idea, the concept of conformity. And when you hear that concept, it simply means that the state government agrees with the federal government. And then when you hear the term nonconformity, that means the state of California is going to do it their way under the Revenue and Taxation Code. So conformity and nonconformity will be discussed in that publication 1001. And I mentioned before, there's a lot of examples. In fact, we're going to talk about some of these examples this morning. Think about the discussion we had about on no tax and overtime, no tax on tips, the interest deduction for a new vehicle. You can take that on your federal return. However, the state of California does not conform, and so that's not going to appear on your California return. And so those are some examples of nonconformity. And then, of course, at the VITA site, you're going to see a lot of seniors on Social Security and certain pensions. Usually, it's something that you're able to address based on that publication 4012. Sometimes you got to get into the publication 1005 from the state of California talking about pensions. And again, that's only for California, but again, a useful document. Now, we don't prepare returns for non-residents. We don't prepare returns for part resident California folks. But you might get questions, and the Franchise Tax Board publication 1031 talks about determining residency. And then we did talk about the 4502. That's the additional documentation required. And what that means is someone files their return, and then they're going to get a follow-up letter. Not all the time, but sometimes they're going to get a follow-up letter from the state of California. And with that, then the California state government may ask for additional information. And if that's the case, then the client's going to have to respond to that. Sometimes they'll come to the VITA site and say, "What do I do?" And so you'll point the way. And as we mentioned, you can point the way for your client. You can give them guidance, if you will, but you don't advocate for them, which means you're not going to call the franchise tax board on their behalf and engage in representation. You don't do that in the VITA program. That's beyond the scope. And then we did talk about the state of California, the FTB, the health coverage exemption, and individual share responsibility penalty. You typically don't see the penalty at the VITA site because most of your VITA clients are going to either have health insurance or they're going to be participating in the California Medi-Cal program, which is going to be free health coverage for low-income folks. And then, of course, individuals in covered California. We're actually going to talk about that today again with our Maria Adams tax return. So again, just different publications. You'll get a lot of questions at the site. Generally, your go-to document for federal is going to be the publication 4012. And for the state of California, it's going to be the Franchise Tax Board publication 5130. Now, what I do at my VITA site, when I get questions, a lot of times I will go to those documents. I'll show the taxpayer, here's the rule, here's the law. And then usually, even though it doesn't make them happy, they understand. And a lot of times they do want to see some type of reference. So again, I think that's a way to do business. But again, you're gonna take a direction from the site coordinator, but it's always good to educate your taxpayers. Taxpayer education is a good thing because they walk out and they understand this is the rule, this is the law. Even though they may not be happy about it, at least they understand where that information is coming from. All right, Robert, I'm going to hesitate and see if anybody has any questions.
They we have a couple questions. One is, what does FTB stand for? That is the Franchise Tax Board. And when do we need to certify by? Before the start of the season. And
Yeah,
that's about it.
and And if I can jump in there, when you talk about certification, we're going into the holiday season. So uh, if you're new to VITA, it's going to obviously probably take you a little bit longer to certify, but it's a doable thing. And when you do get certified, then you're going to have that 13615 that'll be generated from the software, i.e. the Lincoln Learn program. And then that's what you need to bring to your VITA site to show that you've certified, along with some type of ID, so your site coordinator can log you in, so to speak, and say, okay, you are now a volunteer. All right, Robert, anything else?
We have a question about the senior standard deduction. Does California recognize a $6,000 additional standard deduction?
No, California does not conform to that new law where seniors were given an additional $6,000 standard deduction. So that's another example of nonconformity.
And that's it. We'll go from here.
Okay. All right. And so then if you are new or newer to VITA, you know by now that you do have to certify on Lincoln Learn. Now, when you get into the Lincoln Learn program, I checked yesterday, and it is up and running. And what that means is you're going to start with that we call it the ethics test, if you will. That's the standards of conduct. And once you complete that standards of conduct certification, which takes you maybe about 10 minutes, then you're going to go to the intake and interview. And the intake and interview certification probably take you about 10, 15 minutes. And then from there, and this is my recommendation, I highly recommend it. Then you go to the basic certification, complete that. And then I highly recommend then you go to the advanced certification. And then once you complete that, then you're ready to go at the St. Killian's VITA site. Now, there are other certifications. And so, for example, at my site at Coastline College, we require all of our folks to go through those certifications I just spoke of and the military certification. And then there's also a certification for international. But again, for St. Killian's, getting to the advanced level, that's going to be your goal. And then the practice lab, I checked this morning. It's up and running for 2025, with the exception of the California return that's not been loaded. And so, if you want to get more experience in California, what you can do in the practice lab, just toggle from 2025 to tax year 2024. And then that way you can get some practice preparing a California return. Don't know when the state return is going to be loaded, but when it is, you'll see it. But again, right now it's not. We talked about tutorials, and those are included in the landing page when you get into the practice lab. And then the practice returns and solutions, that's in the practice lab. And the practice returns have check figures. And so those check figures, that's a term that accountants use. So you can go ahead and see if you have properly prepared those practice returns. And then you do not need to prepare any returns in the IRIS Practice Lab landing page for married filing separate returns. We don't do that in the VITA program, so you could ignore those. Okay, you're going to get questions regarding, hey, where can I go to get my tax return done? In some cases, because the taxpayer is out of scope. They may have a situation where we simply can't help them because we're not trained to do that. And so, like any line of work, you got professionals out there, and professionals include what we call the big three, if you will. And the big three, first one is a certified public accountant. Most people have heard of that, a CPA. And CPAs, not all CPAs do taxes, but a lot of them do. And what that means is they've gone to college. They usually have a baccalaureate degree in accounting. They've taken some additional training, and then they've sat for a series of examinations, and they've passed those examinations. And then they typically work for an accountant for a year or so, and then they become certified. And then, of course, they have to obviously maintain that certification. And so sometimes people ask me, hey, I need a CPA. Where do I go? I'm thinking, well, if you need a CPA and you're at my VITA site, I'm not going to recommend a particular one, but I'll recommend the Cal CPA website, where you can go to that website and you can look for a CPA in your area. So again, not all CPAs do taxes. For example, I've got clients who are CPAs who did a tax class maybe 30 or 35 years ago, and that's it. And so they come to me, and what I do is I prepare their returns because they're not in the tax world. So you may see that. And then another type of preparer that you'll see are enrolled agents, and those individuals, as we've mentioned before, all they do is taxes. They don't do financials, if you will. They don't do certified financials like a CPA does. And enrolled agents, two ways to become an agent, enrolled agent. You can work for the IRS for 5 years in a professional or paraprofessional capacity, and then you can essentially apply or petition for your enrolled agent status. Or you can go ahead and study for and then take a series of examinations and pass that, and then you become an enrolled agent. And similar to the CPA, you have to maintain your status, which means you're going to engage in continuing education. And so you may see that. And then a very popular type of preparer is called the California Tax Education Council Registered Tax Preparer. And those are individuals who they have to study for, and then they have to take an examination. The examination can be online, or for example, I teach some classes that are CTEC classes. So the students go through an entire semester and they have to take a number of examinations. They pass them, and then they can petition CTEC to become a registered tax preparer. And CTEC preparers, that's usually the quickest way to become a tax preparer in California. Probably the most lengthy way and most expensive way is to become a certified public accountant, but just different types of preparers. And simply because you're a CTEC registered tax preparer, it doesn't mean that you are less competent than a CPA. It simply means that you have a different certification. I've met CTEC preparers that are highly competent and that can handle just about any type of issue. But again, when you're asked by a tax client, hey, since my return is out of scope, where do I go? We tell them, well, you can go out in town, you can go to the low income tax clinic run by run by attorneys and CPAs and other tax people at the city of Santa Ana, or you can go maybe even to AERP. But the bottom line is, if it's out of scope, it's out of scope. You're going to have to go and find someone to help you out. And then you're also going to get the question, what do these people charge? And I always tell people, well, I don't keep up on CPAs what they charge. I know approximately what they charge, but I don't know exactly what they charge. And of course, they're going to charge what the market commands. And so I just tell them, if you need your return to be prepared by a tax person, be prepared to pay that tax person to prepare your return. And that's probably the best information you can give them. But again, as we mentioned, do not direct a VITA client to a specific tax preparer. That's something we don't do. You can tell them, here's the website if you want a CPA, here's the website if you need an enrolled agent, here's the website if you need a CTEC registered tax preparer. But again, stay away from recommending a specific individual. And then, of course, there's other types of preparers. You probably won't bump into them very often. There are actuaries that do tax returns, but you won't bump into that probably. And then some licensed attorneys are also preparers, and usually you don't bump into that. But again, these are the three types of preparers you typically encounter in the paid practitioner world. Okay, and now we're going to introduce you to the Iris Interactive Tax Assistant. And as it says on this screen, and we'll actually get into this in just a moment, it says that the Interactive Tax Assistant, this is a tool where you can actually enter data in the IRS database, if you will. And then what happens is you'll toggle through to determine if the individual has a filing requirement, what their filing status may be, can they claim a certain type of dependent, is a certain type of income taxable or not taxable, are they entitled to a credit, something like that. Now, what will not happen when a taxpayer enters data in this interactive tax assistant, the data is not going to be saved. Their name is not going to be captured. Their social security number is not going to be captured. And so again, it's just a way for someone, which means it could be a tax preparer in the VITA program. It could be a tax client, a VITA tax client who wants to get more information to determine, do I have a filing requirement? Is this, and this is a big one, we see this all the time, is this particular type of income taxable? And so again, this is a an assistant. This is a way to give you additional information. I've used it in the past, and I find this to be really helpful when clients say, well, how did you determine that? And when I start explaining the Internal Revenue Code or the Revenue and Taxation Code, people usually say, just explain it to me in plain language. Okay, no problem. We'll go to the Interactive Tax Assistant and we'll toggle through this, and you can sit next to me. And this is part of the taxpayer education that I get involved in. And what it does, it helps people understand. Again, they may not agree with it, but it helps them understand, okay, I do have to report this particular item as a taxable item on my tax return. Okay, so with that, what I'm going to do is I'm going to jump into this, and so let me go ahead and do that and see if I can figure this out. And Robert, what's that one saying? Best laid plans. All right, it looks like it's not coming up. Robert, let me know. I'm going to see if I can go through the hyperlink here. Let me see if you can see it on the screen here. Let me do the hyperlink. Can you see the interactive tax assistant?
I can see the PowerPoint where you clicked on it, I don't see the actual interactive tax assistant.
Okay. All right. Then what do they say in the movies? And that's probably a bridge too far right now. So you can still see the PowerPoint.
Yes.
Okay. All right. So then, so again, you can go ahead and click on that at your leisure, and you can navigate through that. Just kind of get an idea. Very helpful, and something to keep in mind. This particular interactive tax assistant is not going to be able to help you with every situation that you have. It's going to help you with most situations that you may have. And again, it's just another tool. But do keep in mind your publication 4012, your VITA guide, that will be your go-to document for federal questions and navigating through the software. And that 4012, as I mentioned before, it's written by or revised by IRS employees. It's reviewed by IRS attorneys to make sure it's in accordance with law, federal tax law. And the IRS spends a lot of time on that 4012. They also bring in members of the community, if you will, the VITA community. The last time I worked on the 4012, I think we had a team of about maybe 15 people, and about three or four of them were essentially VITA volunteers, experienced VITA volunteers who worked on the 4012. All right, then we talked about the IRS individual or what we call the IPPIN. And that IPPIN, the whole idea behind this, when people come to your VITA site, is this allows them to electronically file their return. And it's that identity protection, personal identification number. And so when people come to the VITA site, they're going to have a letter from the IRS. It'll have that six-digit code, if you will. And again, we can electronically file their return. If someone says my identity's been compromised and I don't have a six-digit IPPIN, then what may happen, there may be a rejected return. And that's another thing you're going to get into, you're going to hear about. But when you do have a rejected return, it's really up to the site coordinator and what is called the electronic return originator. That's the person who does the electronic submission to perfect that return. And there's different ways they do that. But you're as a VITA volunteer, your concern is if someone has an IPPIN, you can enter that into the software. And again, it allows them, even with a compromised Social Security number, to electronically file. And I see that I don't see that every day at the VITA site, but I see it enough, probably about 10 times during the season, where there'll be someone with a compromised Social Security number. And then, of course, identity theft, obviously, it's all over the place. There's scammers all over. And so if you have someone who wants to file the identity theft affidavit, they can certainly do that. That's all done online. And again, once they do that, they're typically going to receive that IPPIN, which allows them to electronically file. Okay, and then refunds. This is a big thing that you'll see in the VITA program. Not everybody, but a lot of individuals who come to the site, they will be eligible for a refund. And so that's a great thing. Some of these refunds are substantial. I think the biggest refund I've seen walking out of a VITA site was maybe about 11 or $12,000. And so, that's a substantial amount of money. And so when someone says, "Hey, I'm entitled to a refund," and we prepare the return, we say, "Okay, you are." We obviously tell them the particulars, and then we tell them a refund is going to be forthcoming. And the refund, if they electronically file and they have what is called direct deposit, usually it's going to be a lot quicker than a paper check. We've mentioned this before. People are entitled to the paper check, or Treasury now is moving toward essentially what we would call a plastic card, almost like a credit card. And so some individuals may not get the paper check, they'll get that card that looks like a credit card or a debit card, if you will. But the bottom line is that's a refund. And so individuals are going to ask you, and I get these calls during the summertime. I get calls in July, I get calls in August, and they go, "Hey, I didn't get my refund." And so I tell them, well, I can't advocate for you, but since you've called me, let's go ahead and have a short conversation and I can educate you on what you need to do to determine if your refund is forthcoming or if there's an issue with your return. And I tell them, obviously, you need to have your social security number, your filing status, and look at your document to determine. And I mean, that would be your Form 1040, the courtesy return that we gave you. What is the exact amount of the refund that you expected? And then you can go into the refund sections of the IRS website and you can go ahead and determine if there's an issue with your return, if that tax refund is forthcoming. And here's another thing. I get these calls when the season opens up. Individuals say, well, I filed my return 4 days ago and I didn't get my refund. Well, there could be a delay. And again, I can't advocate for you. So I'll educate you and so you can go to the refund section. And here's another thing. Sometimes at the end of the day, you've got to call the IRS. And there's a 1-800 number. Sometimes you got to call them. Or sometimes you got to march down to an IRS office and you got to say, I have an issue with my return. But this refund, I guess you'd call it link on the IRS website. This is probably the tool that you want to share with individuals so they can check to determine when their refund is coming. Is there an issue? And then, as we mentioned before, certain credits, the IRS is going to look into that. So when someone files early in the season, they may not get that refund until perhaps after the 15th of February. And that can happen. That can happen also. So again, the takeaway here, if an individual has questions, go to the website. And what I do is I'll sit down with taxpayers when they come in and I'll engage in education. But when they start saying, hey, I need you to do this and say, I don't advocate for you, that's beyond the scope of the program. This is something that you have to do. It's an individual responsibility. But again, you can share that refund link on the IRS website with them. And before we talk about this, let's go to California real quick since we're talking about refunds. And so California has the same thing. You go to the franchise tax board website, and you'll have a link that says, "Where's my refund?" And same concept, if you will. And so what the taxpayer has to do, they have to have information pertaining to their California refund. So they'll start with their social security number, the zip code where they filed from on their return, the amount of the refund, their mailing address, and they're going to go to that link on the franchise tax board website to determine where is their refund. And same concept. I get questions from individuals that say, hey, where's my refund, Jerry? I'm thinking, well, let's go ahead and I will use polite and care bear language, if you will. I will tell them, we filed your return for you. We don't advocate for you, but we can give you education. So where's my refund link? That's your starting point for California. And then you have to be patient because sometimes California will send you a letter and say, we are prepared to issue a refund to you. However, we need additional information, we being the Franchise Tax Board website. And so again, educating your taxpayer, I think, is important. But at the end of the day, you've got to tell them, this is your responsibility, taxpayer. This is how you can address this. And we at the VITA site, we cannot sit there and advocate and make phone calls on your behalf. That does not happen because again, it's well outside the scope of the program. Okay, then with that, I'm going to go back to my other slide and then I'm going to hesitate, Robert, to see if you have any questions or comments.
We have a question. Someone is asking, are AI sites like Gemini reliable sources for tax questions?
Okay, I heard artificial intelligence and Gemini. Is that what I heard?
Yes, they're asking if just in general are AI sites a good resource for tax questions.
Well, I'll answer your question this way. Your go-to document in the program for federal is going to be the publication 4012. Now, can you use artificial intelligence? Well, I guess you could, but I would go ahead and kind of match that with the 4012. I would use some type of IRS document or what we call IRS authority. And I'll be candid with you. I use an artificial intelligence in my practice all the time. And then I recognize when I'm downloading a document, I'll look through it and I'll recognize that it is not perfect. It's close, but sometimes it's not perfect. And so if you want that spot on answer, you need to rely on what is called IRS or Franchise Tax Board authority or references. And again, your references your 4012, your publication 17, and then for the Franchise Tax Board, it's that publication 5130. And so that's probably a long answer to your question. I would not sit at the VITA site and make queries to artificial intelligence over and over and again, and then to rely on that. That's why the 4012 is published. But again, AI, does it have a use in the world? It sure does. Is it perfect? Not today. And I think I shared this with the participants a few weeks ago. I had one of my one of my folks working for me, and she prepared a presentation on contributions, and it was very detailed. It was for tax professionals. She got it completed in about 10 minutes. I was kind of surprised she got it done that fast. I figured it'd take her about 8 to 10 hours. And I went through it and think, okay, this is pretty good. But it's about a 90% solution. So that means you're going to miss things. So again, I would default to the 4012. I would default to the publication 5130. I would default to IRS publications. And at a VITA site, that's what you would do. Now, if you go to a tax professional, your tax professionals also use those publications, but they also dig into the tax law, which includes the Internal Revenue Code, tax court decisions, federal decisions, tax treaties, things like that. But for VITA, 4012 and publication 5130, go-to documents.
All right. We have one other question is, are the savers credits for the contributions to the IRA and Roth still available? And if so, are they refundable or non-refundable credits?
All right, I'm gonna shoot from the hip on this one. What I believe, what I remember, I haven't touched that topic in a while. I believe the Savers credit. Actually, I'm going to be careful here. I'll probably look that up on the break. But the bottom, I can answer half of that. The Savers credit, when it did exist, if it still exists, the Savers credit was a non-refundable credit, and I will look that up during the break and see the particulars. For some reason that's not in my brain right now.
Very good. We're good to go.
Okay, thank you. All right, so let's go ahead and talk about alimony one more time. And when you're talking about alimony, alimony is something you will see at the VITA site, and you just have to slow down a little bit. You might remember from last week for the federal side of the house, alimony that you receive is not going to, of course, it depends on when you got divorced. It could be included in income or it cannot be included in income. Again, it depends on when you got divorced. And the state of California, as we mentioned last week, at one point years ago, it conformed with federal tax law, and then currently it does not conform with federal tax law. And then starting next year, it will conform. So you just have to slow down a little bit, rely on your publication 4012, rely on your publication 5130 from the state of California to determine if your particular client in alimony or alimony that they paid, i.e., they want to take a deduction, is something they can take. And that's all you have to do. Of course, obviously, you're going to ask about the date of divorce. That's important. And then usually they'll have some type of court instrument. But this is not a real difficult thing to look at. You have to just determine when they got divorced and if it is alimony. And as I mentioned before, I've seen circumstances where an individual was paying money to a former spouse and they thought in their mind that was alimony. And I explained to them, no, it's not, because a judicial officer has to order it. And so if you're giving money to people because you're a nice person or you want to be a nice person, that is not alimony. It has to be ordered by a judge. And when you're talking about alimony, typically it's to a former spouse. However, alimony can be paid to a current spouse. And then usually, again, you're going to have some type of instrument or document that's a divorce decree or a separation decree ordered by a judge. And then there's other rules pertaining to alimony. You're going to have a situation where the taxpayers are not filing a joint return, and that alimony has to be paid in cash. And of course, cash obviously could be currency. Most people will pay by check or maybe even by money order, something like that. And then, of course, they're not going to be members of the same household. There's another rule. And other rules include when you're talking about alimony, you have to differentiate, or I should say, payments made to a former spouse or a current spouse. You have to differentiate between child support and alimony. And a lot of times in a divorce decree, you may not see the words child support. You may not see the term alimony. You may see the term family maintenance. Now, if you're an attorney, that's great. If you're not an attorney, you can still read the divorce decree and you can determine the monies that are being provided to the adult and the monies that are being provided to the adult for the children. If money is being provided to an adult for support, then that's going to become alimony. If money is being provided to the adult on behalf of the children to buy clothing, diaper, and feed them, that would be child support. Child support is not a taxable event. Alimony, again, depending on when the individual was divorced, it could be a taxable event, it could be non-taxable. It just depends. And so again, you had that chart from last week. Just slow down and find out when they got divorced. And again, your publication 4012 and your publication 5130 is going to answer your question. And most likely your site coordinator is going to have a chart, and then that way you can look at when the individual was divorced to determine whether or not alimony is going to be included in income on the federal return and the state return, or whether a alimony payment is going to be deductible on a federal return or a state return. So again, just a couple of moving pieces, but not a difficult thing. And then I'm going to hesitate, Robert, see if you have any more questions on, or any questions on alimony.
No questions on alimony. I do. Someone was just wanting to clarify what was the saver's credit.
Yeah, on break. I will look something up. But again, the Savers credit, what it is it came out a number of years ago, and the congressional intent behind that is for individuals to save money in a like a 401k, a Roth IRA, something like that. Because Congress looks at it and says, if you save money over a long period of time, it doesn't mean you're rich. It means that when you get to a certain point in your life, you're going to be able to provide for yourself. And that's a congressional intent. But it was a non-refundable credit, the Savers credit.
Okay, that's all we have.
Okay. All right. And we talked about the FTB. And then what we're going to do now, we're going to walk through this, and then we're going to actually go through the preparations. So we're going to point out a few things. This is the Lisa and Robert Walters tax return, and we're going to prepare a return for 2025. And so let's just run through it, and we can have a discussion. But let me just point out a few things. So we have our administrative data for the Walters, and they're going to choose to file a joint return. And this is another thing that you're going to see at the VITA site. You're going to have individuals who say, I'm married, I'm legally married, but I don't want to file a return with my spouse. And that's something they can do. However, at the VITA site, we will not prepare a married filing separate return. And sometimes you're going to have a taxpayer who says, well, I've got a really easy return. You say, okay, then again, we can't help you. So when you go to your tax professional is going to ask you questions about your spouse's income, your spouse's name and social security number, and a paid professional will be able to help you out with a married filing separate return. But we do not do that in the VITA program in California. Now, you may have someone coming from another state and say, well, they did it in the other state, and say, well, that's the other state. In California, we don't do married filing separate returns. Okay, then moving on, the administrative data you can see at the very top there. Usually you're not going to have an issue with social security numbers, but a reminder, the reason in the VITA program, one reason we ask for a social security card is sometimes people will forget their social security numbers. I've seen that many times. And so this is why we ask for the social security card. not only for the adults, but also the children on the return. And that's pretty much non-negotiable. There are, I guess, a few exceptions, if you will, but generally you get that Social Security card. Date of birth, that's not an issue. Right now we have seniors. These two individuals, they're over 70 years old, and you're going to see on the return that we prepared, they're entitled to the senior deduction, that additional amount, which is $6,000 per person. And then moving on to the next topic, it says Robert was issued a medical report from his eye doctor saying that he can't see better than 2200 in his better eye with glasses or contact lenses. And you're going to see a lot of this as individuals get older. Usually they have issues with their eyes. And sometimes, obviously, they have to wear glasses, or maybe they get to the point where, under the tax definition, they are legally blind. And what you see there for Robert, that's the tax definition of legal blindness. And the reason we're concerned about that is because Robert then is allowed an additional standard deduction if he takes the standard deduction on his tax return. And so make sure when someone says, yeah, I've got poor vision, then you want to determine what is your vision. Do they have some type of document from their optometrist or ophthalmologist? And but again, this is an additional standard deduction. And I've seen this a lot of times at the VITA site. Typically, not all the time. Typically, it's seniors. I think the one example I had, I think I shared with you a few weeks ago. I was conducting a Zoom session with one of my VITA clients, and she was a young lady, probably maybe 25 or 30, and she was showing me documents. She was explaining her tax situation, and then she finally says, Jerry, you probably don't recognize the fact that I am blind. I said, no, I did not. And so we had a short discussion. She says, yes, I'm blind. I cannot see. I have no vision. And so I said, all right, that entitles you to an additional standard deduction. And in her case, she did take the standard deduction. The address is stated here, and you can see that the Walters paid property tax of $3,000 and then DMV fees. And then just a quick reminder for the Department of Motor Vehicles, you're going to have individuals come in with their DMV bill, and you're going to see a one-line entry on the DMV bill that says this may be allowable on your tax return. And the short answer is that's what you're going to take for DMV fees. Phone numbers, we talked about that. You're going to capture both husband and wife's phone number. When our VITA staff has to perfect a return, which means the return has been electronically rejected, and we're trying to change it to make sure that it can be electronically filed. Usually, we'll go ahead and either call or sometimes send the individual an email. So capture that, and of course, they're going to walk away with a courtesy return, but sometimes the return is rejected for various reasons. And this is another thing. I've had VITA clients, the return is rejected. I contacted them and said, hey, your return's rejected. We need to confirm something so we can perfect it and then e-file. And sometimes that doesn't work. And at the end of the day, I tell them, we tried. And usually after a couple attempts, then we tell the client, go ahead and mail in your federal and or state return because we are unable to e-file it. And that is going to happen. It is far from a perfect world in tax. I do that in my practice, although it doesn't happen all the time, but it happens enough where you just have to be prepared to, as a taxpayer, mail in that return. This is on this particular fact pattern, we have Lisa. She's got an SSA 1099. Your Social Security recipients are going to be receiving that document, and you're going to have the box 5 amount. We're going to show you how to enter that. And then generally, and this is something you will see most of the time, most seniors 65 and older, most of them are on Social Security. Although I had mentioned before, I don't think there's a statutory requirement for you to sign up for Medicare. And so, but generally they do because Medicare is for seniors. It's pretty inexpensive insurance. But again, the 1099, the SSA 1099 is going to be issued to the taxpayers. So you can see the Medicare premiums. You're going to have federal tax withheld sometimes. and that's reflected there. And then Robert also is on Social Security. He also gets the SSA 1099. And same situation, he's got his box five amount. He pays into Medicare and has tax withholding of 1,000. Usually on your SSA 1099s, you're not going to have federal tax withholding, but you want to look for that. And that also means on any document that someone gives you, a W-2 or a 1099, you want to obviously key it as you see it, but sometimes you're going to have tax withholding. You want to make sure you indicate that in your software, and that could be tax withholding on certain types of 1099s, certainly W-2s, and then also for Social Security. Your bank accounts, when you do have a bank account, we ask this information and we ask the information. Let me restate that. For this particular individual, they have a joint bank account and they have interest from the Bank of Pecunia, and it's a total of $800. And so you're going to see individuals who have bank accounts, and sometimes they have a lot of interest they receive from the bank, and sometimes a small amount. Keep in mind, if they receive $1 of interest income, it's going to be a taxable event. And if you receive less than 10 bucks of interest income, typically the bank's not going to issue a 1099 INT to you. But again, whether it's $1 or $1,000, that's going to be reported on their tax return. Next part of the fact pattern, we've got Lisa. She's got a Schedule C, that's a sole proprietor. And you're going to see the term materially participates. And so what that means is she's involved in the business in a regular and ongoing fashion. And she's a tutor. We're going to get into this. She has payments or gross receipts of 14,000. When you have a Schedule C, a lot of times your taxpayers, when you ask them, what were your gross receipts? What was your total income? Sometimes they're going to hesitate because they don't have what we would call a developed accounting system to account for their gross receipts. Sometimes they say, well, gee whiz, I wrote it down, but I can't remember. And so you're going to give them a little bit of time. Maybe they're going to reconstruct. But most people who are self-employed, they have some method to record what they made, whether it's a scratchy piece of paper or QuickBooks, or maybe they've got a good accounting of that. I know one individual receives self-employed, receives cash, currency, Zelle payments, checks, whatever negotiable instruments, and everything goes directly into a business bank account. That is yet another method of accounting for your gross receipts, and you'll see that too. So anyway, she has 14,000 of gross receipts and she has some supplies. And we mentioned this a few weeks ago. When you have a self-employed individual, they will typically come in with a piece of paper with items. They'll say, here's the supplies, here's mileage, here's my telephone, if that's allowed. And so what you're going to do, you're going to ask some questions about these expenses. Are they ordinary and necessary? Is there a business purpose, and is it reasonable in amount? And probably the one sticking point you're going to have in the VITA program, individuals will say, I've got a cell phone. And you'll say, okay, and tell me about your cell phone. Well, I've got one cell phone and I use it for my business. Well, that begs the question, since you have one cell phone, what about your personal life and what about other things that you do in your life? And they'll say, well, I have one cell phone and I pay a flat fee of 60 or $70. In that particular case, they're not going to be able to deduct their cell phone. If they have an itemized list from their provider, from their carrier, then you can get away with obviously entering the amount that was specific for business. And I think I used the example before. Jerry Muir has one cell phone. I have one cell phone. I use it for everything in my life to include my practice. I do not deduct my cell phone on my Schedule C, even though I use it about, I guess, probably 60% for business. And so, same concept with your VITA clients. They're not going to be able to get away with that unless they have that itemized list from the carrier. And then in this particular case, Lisa has made an estimated tax payment. And this is very typical. When you hear the term estimated tax payment, you're thinking four quarterly payments during the year. Sometimes your clients will make only one, and so you're going to capture that data. I remember the first time I saw an estimated tax payment on a VITA return, I'm thinking, well, this is interesting. And now it's commonplace. I see it all the time. And so when someone makes the estimated tax payments, make sure you capture the information pertaining to federal estimated tax payments and then California estimated tax payments. And sometimes your clients will make both. And then stock purchases. Lisa has a stock that she sold. She bought it in 2020, sold it in 2025. Automatically, your software is going to determine that as long term. And you can see that she purchased it for 6,000, sold it for 1,000. We know right then and there that is a loss, and she's limited to $3,000. We're going to show you how that shakes out on the return. And then something I see again and again at the VITA site, people come in typically with a postcard from a law firm. And let's say I got this postcard from this law firm. I was part of a class action lawsuit and I won $100, or not won, I received $100. I got $500. Is this a taxable event? And the answer is it depends. And so you got to get behind those numbers and say, well, what was it for? Was it for intentional infliction of emotional distress? Was it for lost wages, i.e., back wages, if you will? Was it for reimbursement for medical expenses? What was it for? And then once you determine that, then you'll be able to enter that in the software. In this particular case, lost wages, i.e., back wages, that's a fully taxable event. And of course, this happened in 2025. The settlement was in 2025. It could have been from 2022, 2023, but the settlement was in 2025. And we talked about the concept of a cash method or a cash basis taxpayer. You're going to report your income when you receive it or when you have constructive receipt. So, for example, I had a job a few years ago. I worked in the month of December. And the payroll person said, Jerry, we can get you paid. You got to fill all these forms. I said, yeah, I'll be back in a few weeks. And she goes, well, then we can't pay until January. I said, no sweat. And so what happened is I filled out all my paperwork in January and they paid me in January for the work I did in December. Since I'm a cash method taxpayer, the monies that I made in January, I reported for that particular year, not for the previous year where I earned the money in December. So again, cash method, what you received, what you actually received, or had constructive receipt. Your PIN, your personal identification number, if your taxpayer selects it, great. At my side, I usually just select one for them. Okay, new information here. We have the Walters, they purchased a new automobile, and this particular automobile qualified for that new interest deduction under the One Big Beautiful Bill. You might remember if you have a very, very large truck, that's not going to qualify. You have to determine it's within gross weight limitations, but a sedan or a passenger automobile certainly is. So this is the data you want to capture for someone who has a new car in 2025. You want to capture the vehicle identification number, and that's going to be listed on the sales document and also on the title. You're going to capture the amount of interest that they paid, and that's going to be typically the documents that they because they financed it from the finance company, and then the date that they purchased the new vehicle. And then with that data, you're able to enter that. We'll show you how to do that today so the taxpayer can get the deduction, which appears on the new Schedule A-1. And then the bank account information, this is their bank account. And in the VITA program, the vast majority of your clients want direct deposit, and a lot of them want direct debit, which means that let's say they owe money and they go, just take it out of my bank account. And this is where you want to make sure you capture the correct bank account number, the type of account, whether it's a savings or a checking, and then the routing number. Your routing number, that's the American Banking Association, that is public information. And now your account number, individual account number is not. So sometimes people, like if you ask me right now, Jerry, what's your routing number? I have no idea. And but I know where to get it. I can go and look at my check, or I can Google my bank and I can find the routing number. What will happen at the VITA site? Your site coordinator most likely will have a short list of banks with routing numbers. Because some people they don't know it, and a lot of people, especially young individuals, they've never seen a check. They don't use checks, and so they have to go online to determine what their routing number is for their financial institution. And then, of course, if you do owe, and some people owe in the VITA program, sometimes people say, I don't want direct debit. I don't want money coming right out of my check. I want to go ahead and write a check to the IRS and or franchise tax board, and I'm going to mail the check in. And that's certainly acceptable if you want to do that. But again, having a direct debit, money taken directly out of your account, that's probably the quickest way to do it and probably the safest way to do it. All right, so here's our fact pattern. I'm going to hesitate and see if anybody has a question before we take our first break.
So we have a question on the new car interest. How will we know if the car is eligible or not?
Well, what you'll do is you'll ask them, did you purchase a new vehicle in 2025? And if they say, yes, I did, tell me what type of vehicle, make and model. If they say I pictured, or excuse me, I've purchased a Mack truck, which it's a 20,000 pound truck. Clearly, that's not a sedan. That is not eligible for the new interest deduction. If they say I've purchased a brand new Hyundai Tucson. That is an SUV, and that's clearly something that qualifies. And then of course, you're going to capture the VIN and the interest that they paid. And the interest that they paid means they financed it through a finance company, some type of bank, and they're going to receive a document that shows them the interest that they paid on the loan. And then when you're talking about a car loans typically are what is called a fully amortized loan, which means you're paying a monthly payment. Maybe you got a 4-year loan. And so that means every month you're paying some principal and some interest, and you're only allowed to deduct the interest. And that's probably the long answer to your question.
And then a question about the Social Security card. Everyone needs to bring in their Social Security card so we can see it. But if they have a SSA 1099, is that okay documentation for their Social Security number?
Yes, it is. Yes, it is. If you have the SSA 1099, you're going to have a full Social Security number on that particular document. And then sometimes you might have a document from the Social Security Administration, and that's also acceptable. So yes.
Okay, so and then on DMV fees, which uh if someone doesn't have a form, how would they know what DMV fees they have
Well,
is what the question
yeah,
is.
that's probably a tougher one there. If someone doesn't know, and it's a modest, well, first of all, you want to determine is the individual going to be allowed the itemized deductions? If they're allowed the itemized deductions, that means their itemized deductions are greater than the standard deduction, and so then yes, then the DMV fees would be applicable. Probably a call, maybe going online. Usually, I guess you can even estimate. I've done that before. But if someone says they paid $300 in my DMV, well, on your bill, that's your total amount, but that is not your total deductible amount. There's a Latin term called the ad valorem amount, and so that's when you need the DMV bill. I probably the best way to do it might be to you might be able to estimate, or you might be able to say, go to the DMV, call the DMV, go on the website to determine that portion that you're allowed to deduct on your Schedule A. Okay, sounds great. So, real quick, let's talk about the so-called Savers credit. The Savers credit is a live and well, and this particular credit, also known as Retirement Savings Contribution Credit, that particular credit, again, it's a non-refundable credit, and if a taxpayer is eligible for it, what happens is they're making contributions to some type of savings plan, maybe to a 401k or 403b or something like that. And this particular credit depends on their filing status and their adjusted gross income. So that's calculated automatically. And you'll see the IRS form 8880 you'll actually see that in the software and you'll populate the 8880 and the software will determine whether or not your taxpayer is eligible for the credit. The IRS Form 8880 is called the Credit for Qualified Retirement Savings Contributions. And you can see the discussion on the retirement savers credit on starting on page G as in golf 19 in your publication 4012. So hopefully that helps you out. Okay, let's do this. Let's jump into the Walters tax fact pattern. So I've already entered the data, so let's go to the client search. And if you're new to VITA, when you've entered your data in the software, then you're going to see something like this where you have the various returns that you have prepared. And so let's go ahead and select our Lisa and Robert Walters. And we're just going to go through the whole thing. We'll talk about it and we'll answer any questions that people may have. Regarding that 8880 for the retirement savers credit, if you go to enter the form up here, you can click there and you can actually type in 8880 and you can see where that particular form is going to populate. And then if you had someone who's making a contribution, then you can make your entries there. Okay, so let's get out of this. And let's go back to our fact pattern. Okay, so we're going to start with the filing status. We already know that married filing joint is an election. You choose to do it. No one can force you to do it. And probably if you do have challenges, and we all have challenges at the VITA site, probably a little bit of a challenge, maybe from time to time, head of household. And this is what I do when someone shares a fact pattern with me. If I don't know it off the top of my head, it's just a good idea to jump into the 4012. There's a decision tree and it talks about filing statuses. And so what you can do is you can listen to that fact pattern, review documents. Now that you've got the fact pattern, go to your decision tree in the 4012 to determine if they're eligible for one of these filing statuses. But head of household is probably a little bit more of a challenge in single or married filing joint. But again, head of household, not insurmountable. You have someone typically, they are unmarried and they've got a minor child typically, and they're paying for the household. And if they meet other requirements, then of course they can take that filing status. All right, our taxpayers are married filing joint. Real quick here, names, not a big issue, but again, right from the Social Security card, so we're not going to use nicknames. We're not going to truncate it. We're going to use the name per the Social Security card. And what that does is when we file the return electronically, we're not going to have a rejection. And like, for example, I had a client, I've known the guy for many, many years, and he says, hey, of course, I didn't do his return. I just knew him. He goes, hey, I want you to do my return. And I did his return. I said, this is your first name? He goes, yeah, I never use it. But for tax purposes, he does because it's on his Social Security card. Okay, we got our date of birth, and this particular taxpayer is eligible for that senior deduction that we talked about. And you can see here, we put the spouse, let's see, Lisa, she's the wife. We put her name first. It really doesn't matter. Whoever wants to go first in the return, a lot of times the guy wants to go first and thinking, that's fine, but it doesn't matter. In this particular case, Lisa happens to be the first one on the return. They've decided to contribute money to the presidential election campaign fund. This will not change the amount of their refund. And don't get into a political discussion. You're going to have all different types of flavors at the site. Just avoid that. That's something you don't want to get into. Your spouse, in this case, it's Robert, and we've captured his social and his date of birth. And then this is where we've captured that Robert is blind according to the tax definition of blindness. And as I mentioned before, he's got 2200 vision in his better eye with glasses or contacts. And so that meets the tax definition of blindness. Typically, when individuals want to get that particular designation for the additional standard deduction, they're usually going to have some type of report from their eye doctor. And then he too wants money to go to the presidential election campaign. Address is usually not an issue, but just kind of hesitate here for a moment. When individuals move, then and they may even ask you, hey, I'm going to be moving here soon. What should I do? Well, when you move, you typically tell all of your friends and your enemies where you're going. And same thing with the IRS and the franchise tax board. When you move, if you want to, you can wait till you file another return, but you really should notify the FTB and the IRS that you have moved and here's your new address. Because sometimes the IRS and the FTB want to send you a notice, they want to send you information, and if they send it to your last known address and you don't get it, then it's on you, not on them. So again, when you move, share that information with the FTB and the IRS. We've indicated California, and as I've said before, this software will prepare returns from all the various states that have individual income tax, but we only do the California state return or residential return for our VITA clients. Capturing a phone number, this is not a big deal, but I always, for married couples, I want to make sure that we capture their phone numbers because if we have to contact them to perfect the return, then we need to have a phone number. Sometimes the wife won't answer, sometimes the husband won't answer, so we'll call the other individual. And then capture an email address because sometimes I've noticed this over the last few years, both young and older adults, for some reason, they don't like calling people. I've got many people in my practice, the only way they communicate with me is via email. And so I capture their email address and I communicate via email, but capture that in the event that we need to contact them, again, typically to perfect a return. Okay, we hit that. We've indicated the filing status, personal information. This is the tab for the IPPIN that we talked about. You won't see this a lot, but you'll see it enough. And so when you open that, you're going to have that letter from the IRS, and this allows the taxpayer with a compromised Social Security number to electronically file a return. And so this is where you would go here for that identity protection, personal identification number. Okay, then we go there. And then we've talked about the W-2 in detail, and we're going to talk about that again for the next tax return. But for W-2s, you're going to ask the individual for a paper W-2. And as I've mentioned before, sometimes, and this is typically with younger adults, they're going to turn their electronic device toward you and say, it's on my electronic device. And then what we do, at least at my site, we will have to take custody of that device because we go to a second story, a second floor to prepare the return where the taxpayer is not there. But anyway, in some cases, you may have to obtain their username and password. And if that's the case, I just tell the individual, if we need to do that, then I need this information along with your electronic device to complete your return. But at St. Killian's, I think you're all on one floor. So literally that taxpayer can turn that electronic device around and you can enter data in the software based on the entry from again, the electronic device. Okay, and so now we're going to go to the first item. First tab is our 1099 INT, and you should be familiar with this. And we're going to open this up. This is interest income received. So the name of the bank, your bank's going to have a employer identification number. And then there's the address, typically reflected on the 1099 INT. Here, you're going to have taxpayer, spouse, or joint account. And a lot of married couples, not all of them, but a lot of married couples have a joint account. And that's what we have here. Okay, a couple of things here. Interest income received by the taxpayer, that was $800. Sometimes you're going to have that early withdrawal penalty. And that means they typically have a certificate of deposit at their bank. And when they go to the bank, like for example, I signed up for one a couple months ago. I went to a bank. I signed a contract, and that's what you do. You sign a contract and you give them money, and they're going to give you your principal back when the certificate of deposit matures, along with your interest. And sometimes you can break the contract which means you go to the bank and say, I want my money now. I don't want to wait for maturity. And in that case, there's a penalty, and that penalty is going to be interest that you would have received. And that would be an early withdrawal penalty reflected in box two. So you see that from time to time. And then sometimes you're going to have federal tax withheld because everything's different, everybody's situation's different. And so you might have an individual who has tax withheld from interest. And if that's the case, that's reflected on box four, and you report that there. And then another thing you may see from time to time, foreign tax paid. And the mantra is we key it as we see it from the 1099 INT. When you see that, that simply means the taxpayer has paid foreign income tax. And so, for example, I think I mentioned this years ago. I had purchased interest in an Australian gold mine, and during the tax year, I had to pay income tax to the government of Australia, and that is eligible for the foreign tax credit. And so you may see that. All right, so that's all we have there. And then here's our dashboard. And of course, if you have 1099s from various financial institutions, then you would add it and you'd come up here where it says add interest. And of course, dividends, just a quick aside, when you have someone who is a shareholder or a stockholder in a corporation and they are receiving or have constructive receipt of dividends, then you report that here. And constructive receipt of dividends would be a dividend reinvestment plan. So for example, one of my investments, I'm invested in Caterpillar Corporation. And when I signed up years ago, I said, hey, the dividend, I appreciate the dividends. Don't send the dividend to me. I don't want to be bothered by a few dollars. Take those dividends and purchase additional shares. That's a dividend reinvestment program. I receive a 1099 DIV from Caterpillar because that's constructive receipt, and you have to report that even though you're reinvesting it. So you do report that again as constructive income. All right, so that's the interest, and now we're going to go to Social Security, and Social Security is going to be that 1099, or what we know as the SSA 1099. Keep in mind, you might have someone who has worked for the railway. And if that's the case, they're going to get an RRB 1099. It's basically the same thing as Social Security because that is essentially in lieu of Social Security. So what happened is when Social Security came about, there was all sorts of exceptions. So for example, college teachers working for community colleges and public colleges in the state of California, they have their own retirement system called CalSTRS. And so if they've worked in CalSTRS all their life, they're not eligible for Social Security. Well, when you're working on the railway and you're eligible, then you're going to get a RRB 1099. You're not going to receive Social Security. You're going to receive railroad retirement benefits. So again, same concept, if you will. So we open that up. Now, this is going to look a little bit different if you join us for VITA last year, but it's pretty basic information. You're going to key it as you see it. And so we have two individuals who received Social Security. This is going to be the box five amount. In her case, this is Lisa, that's 17,000. She had federal tax withheld, and you will see this from time to time. And then for tax year 2025, the Medicare premiums look a little bit different as far as the way you enter them. And so we're going to open it up and I'm going to show you the box you're going to see for Medicare premiums. And so this will be reflected on the SSA 1099, Medicare, and then the dollar amount that was paid. And you simply make that entry. And not every one of your Social Security recipients is going to be receiving, let me restate that. Not all of your Social Security recipients are going to be paying Medicare, but the vast majority of them will. Okay, so we've got that, and that's for Lisa. And we cursor down, and now this is going to be for the husband, Robert. We can see the total amount of Social Security benefits, and that's $32,000. And we have tax withheld for Robert. And then same concept, he paid into Medicare. And Medicare, I'm not an expert in Medicare, but all I know is if you pay premiums, and you're typically, I think you have to be 65 if I remember correctly to be on Medicare. You pay premiums, and then what that entitles you to is you're going to have usually coverage. Um, your coverage may take care of all of your medical expenses, or maybe you have to pay some out of pocket. But basically, it's medical coverage, if you will. And when you're talking about coverage under the Affordable Care Act, this is what is called insurance coverage. There's different ways to get insurance coverage. This is insurance coverage. We open that up, and this is for our taxpayer, Robert, and this is the Medicare premiums. And then just a quick aside, and I want to open this up because you may see this once in a while. I think I've seen this maybe 3 or 4 times at the VITA site. I usually see it maybe once or twice a season. So just a quick aside, you might have someone who comes in and says, I received a large Social Security payment. And what it is, I filed my claim a number of years ago. They finally paid me, and the claim covered years 2023, 2024, and 2025. That would be a lump sum payment. And there's an IRS document that talks about it for Social Security, and the worksheet is right here. You'd open this up, you determine there's a lump sum payment, and then you would follow the entries here talking about your lump sum. So, for example, the first question is year the lump sum payment was made for, and then it gives you the various years. So you would follow this for that lump sum payment, and your publication 4012 talks about it, and then there's a Social Security IRS publication that talks about lump sum payments. So you do see this from time to time. Okay, we're going to cancel out of that, and we are done with our Social Security entries for our taxpayers. And we're going to hit continue. All right, and then next on our list is going to be the Schedule C as in Charlie. And you will see it's probably, I guess, at the VITA sites that I've been to, it's probably about maybe 10% of your taxpayers, but you will see Schedule Cs. And usually it's going to be a sole proprietor. It's going to be very modest income, and they're typically going to have some type of expenses. So let's go ahead and open that up. And we can see our dashboard here. And our dashboard shows that she had income of 14,000, or what we call gross receipts, total income. And then she had a total expenses of $500. And then her net income is the difference. And then keep in mind that net income, it's going to be subject to self-employment tax, and she will most likely be entitled to what is called a qualified business income deduction, which is a 20% deduction. Great for the taxpayer, not great for the treasury. All right, let's open that up and see what we have here. We're going to start at the very top because some of you, I know we talked about this a few weeks ago, might be a refresher. If you have someone who does not have doing business as, which means a fictitious business name. So, for example, I don't have a fictitious business name. In my practice, I'm just Jerry Muir. And so I would not fill in this data that talks about name and address and all that. You can leave all of that blank. But if you have a fictitious business name, then your business name would be up here. And of course, we have Lisa. Let's say her fictitious business name was Lisa, the Great Tutor. Then that's what you would type in where it says business name. And that's usually referred to as doing business as, or a fictitious business name. Fictitious business names are obtained by filing with your local county that you have a fictitious business name. Your employer ID, that would be your employer identification number. If you're self-employed and you don't have employees, typically you're not going to have an employer identification number. So we're going to leave this blank for our taxpayer. But we will come down here, and this is your business code. This is a voluminous list, and let me open that up. You could literally spend hours on this list. And so what I tell my VITA folks at my site, I said, let's get as close as we can, but we're not going to spend hours going through this list. And so I'm going to go back here, and I'm going to show you what I came up with. I came up with education. She's a tutor. That's close enough, and that's the business code 611000. and that's good enough for our purposes. Okay, so we've talked about the basic information. Let's talk about the questions for the business. We only deal with cash method taxpayers. If someone says I'm an accrual method taxpayer, that's outside of the scope of VITA. We don't deal with taxpayers who have inventory that's outside of the scope. And so in this particular case, it becomes pre-populated with cost. We leave that alone and we move on. Questions. This also comes pre-populated. Material participation. We're not going to make any changes there. And then toward the very bottom where it says all investments at risk, that comes pre-populated. We leave that alone. If you do have, and if I remember correctly, this is also in scope. If you have someone who's a qualified joint venture, that means you've got a mom and pop operation. They're both involved 50-50. They both materially participate. And in that case, you're going to check that where it says qualified joint venture. And then what happens is there will be two Schedule Cs that will be generated because both of them are involved 50-50. I don't see that very often. When you do, that's what qualified joint venture is. And keep in mind, when you hear the term qualified joint venture, that is not a partnership. If you have a partnership, you would file a partnership return. We don't do that in the VITA program. Okay, and then we're going to go to income. And I may have mentioned this a few times. This can be a little bit, not a huge challenge, but a little bit of a challenge. You'll ask people, hey, what's your total income last year? What were your gross receipts? And they'll kind of hesitate and they'll look up in the sky and they'll start thinking. That means that individual probably doesn't have a really well-defined accounting system to determine gross receipts. And everybody has their own accounting system. But at the end of the day, you want to determine what they receive. So sometimes they'll end up whipping out a calendar, reconstructing their gross receipts in front of you. This is something your intake person should address and say, okay, before you get to tax preparation, let's make sure we have your gross receipts. And that may be evidenced in part or in full by a 1099. And sometimes, like I had an individual, he collected, I think they're aluminum cans, and I guess he made money. He would collect it every day. He'd go down to a recycling plant, he'd drop it off, and they would pay him. And I said, "What are your gross receipts?" He goes, "Oh, I wrote it down on a piece of paper." There you go, gross receipts. But you're going to see different accounting systems, if you will. So that's all we have there. Gross receipts for the taxpayer at 14,000. And then we don't have cost of goods sold in the VITA program. That's outside of the scope. That would be inventory. You will have general expenses and you will have vehicle expenses. So let's talk about your general expenses. So your general expenses, your taxpayers will typically come in with a piece of paper and they'll list maybe supplies. They might have insurance. They might have perhaps maybe mortgage interest, maybe legal and professional, something like that. And so you'll take that title and you'll find a title here in the software. And in this particular case, our taxpayer paid $500 for supplies. And again, is it ordinary and necessary? Is it reasonable and amount? And is there a business purpose? And yes, it is. Taxes and licenses, keep in mind when you're paying taxes, you're not going to enter federal income taxes on this line. You're not going to enter franchise tax board tax. This might be some other type of tax. It might be like a payroll tax, which we don't do in VITA. Licenses you're going to see because in the state of California, there's a lot of licensing requirements to do certain types of jobs. And so that would be a license fee, if you will. Travel, we mentioned this before. Let's say you have someone who takes Uber going to and from their clients. That would be an example of travel. And in this case, we just have the supplies. Wages we don't do in the VITA program because that's outside the scope. We don't do that. All right, let's go to vehicle expense, kind of review that once again. They have to have a method of accounting. And so when you ask them how many miles did you drive for your business, They usually have a calendar, whether it's paper or electronic, and they will account for their business miles. And once they do that, you're going to enter the information regarding the vehicle, when the vehicle was first used in the business, and then you're going to differentiate between the business miles, commuting, and other. And I'll give you some examples. So in my business, like I'll leave my office. I will drive to, like I've got clients in Newport Beach. I'll drive to Newport Beach. I guess it's 15, 18 miles one way. And then I drive back to my office. That's clearly a business mile. So I'll indicate that in my accounting system. My commuting, let's say I drive from my house to the college that I teach at, and then I drive back from the college to my house. That is a commuting expense. That is something that is not deductible. So you would differentiate between business and commuting. Other expenses, let's say I go to Vegas to have a great weekend, that would be other expenses. And so you'll capture business miles, commuting, and other for your vehicle expense. And your vehicle use, you're going to indicate this information down here. Do they have a vehicle available for use after hours? And do they have evidence supporting the deduction? Typically, you're going to check all three of those and you're going to move on. All right, I'm going to hesitate for a moment and see if anybody has any questions regarding the Schedule C or anything we've done thus far.
We don't have any questions on the Schedule C. I have one comment. Someone's asking, isn't the PIN the number one plus the last three digits of their social security number?
It can be. Yes, it can be.
Okay, that's that. And that's about it that we can answer right now.
Okay. And then just one more comment about vehicle expense. With my clients, my VITA clients, they come in and a lot of times they say, well, I don't know what I drove. And so, and this is permissible. I'm going to help them out as best I can. I'll say, okay, well, let's talk about your business. Where do you go to visit your clients, pick up supplies? And then we'll get a calendar for 2025, and I'll have them kind of sit in the corner, if you will, and they'll do their reconstruction right then and there. And then sometimes, like I've had clients who go, well, Jerry, I drove 60,000 miles. I said, okay, let me go ahead and paint a picture for you based on the data that you're providing me. To drive 60,000 miles and do all the other things in your life, that means you need so many hours to do that. And basically I said, this doesn't make any sense. I don't feel comfortable doing your return. And the only person I know that drove 60,000 miles in 2025 is one of my paying clients who drives full time for Uber. And you might see that, but typically, the reason I mention that, you don't want individuals saying I drove 100,000 miles and automatically plugging that in and giving them a very large deduction because that doesn't make any sense. And so again, reconstruction based on where they drove and when they drove. Okay, we're going to hit cancel, get past that. And I mentioned before, we do not calculate depreciation in VITA. Sometimes people say, "Hey, I've got a car. I got depreciation on my car. I got oil. I got gas. I got tires. I got automobile insurance," and that is the actual expense method. We don't do that in VITA. We do the standard mileage in VITA, and also tolls and other things. But if they want the depreciation to be calculated and all those other things for a vehicle, outside of the scope, they're going to have to go to a paid tax person. And then one other comment, some people may say, I've got my home that I use for my office. That is outside the scope of VITA. That's the home office deduction. And that's something where the taxpayer has to go somewhere else. All right. Here's our dashboard for our client, our VITA client. And you can see right here, net income is 13,500. And sometimes when you have that brief discussion with them, they might say, that's a little low or that's a little high. And then you're going to go back and maybe have them look at expense and say, something, no, I didn't have this expense, and no, I didn't have that expense. You're going to see that at the VITA site. And so what you're going to do, essentially, you're perfecting that information that they originally gave you. And then some people will come in, they're ready to go. They've got all their income, they've got all their expenses, and you just want to enter that data for them. All right. And now we're going to go to our next topic. Over here on the left-hand side, we have capital gains, and I can open that up here where it says capital gains, where I can go down to the tab that says Schedule D as in Delta, and I can open it up here. But let's go over here to the left-hand side and open up capital gains. Okay, here's our display. We have total proceeds of 1,000. We sold our shares for $1,000. They cost us 6,000. And so, of course, that means we've got a loss of 5,000. And the rule is you're allowed a $3,000 loss in your return. And so in this particular case, the difference would be 2,000 because she's only allowed three. And that 2,000 would be carried forward to tax year 2026. And so that's how that works. Okay, we're going to open this up. And we have this particular shares are owned by the taxpayer. We described it. Peloton shares, Peloton. Date acquired. This is when she bought it. And of course, if you have an alternate option, you can indicate there, but you would indicate again when it was purchased. Mentioned this before. If you have a whole bunch of shares and you've got a whole bunch of sales, then you probably want to aggregate. It's going to be up to really your site coordinator, maybe you. I've had taxpayers come into the VITA site and they had a very extensive brokerage statement. And I would look at it and say, okay, this is going to take about 3 hours to make entries into the software. And I'm not going to do that to one of my folks. So we're going to aggregate. And sometimes I get pushback from the VITA client. I tell them, well, this is my site and we're going to help you out. And aggregation is an acceptable means. I do that in my business. And aggregation simply means you're going to add up all of your proceeds, you're going to add up all of your costs, and you're going to have one line entry for short and one line entry for long term. And then that way, it's going to save a whole lot of time. Okay, so date acquired, 2020, date sold, 2025. We know automatically it's a long-term situation here. Long-term simply means it's over 1 year. You held the shares over 1 year. And then, of course, we talked about this before. This is generally what you're going to see. You're going to see someone that comes in with a document that'll be titled a 1099-B. And 1099-Bs are like people. They will all look different. I've literally looked at probably about maybe 500 or 600 different types, and they all look different. And then sometimes the 1099-B will have cryptic information in it. So you've got to Google it. Sometimes you got to call back to the brokerage house and say, what does this term mean? But typically, the 1099-Bs will explain information pertaining to the shares that have been purchased and sold. And usually, the cost basis is going to be reported to the IRS. If it's not, then what I do with the client, I say, okay, you sold it, it's your shares. So you tell me, because you lived it, I didn't, what'd you buy the stuff for? And usually they say, well, I don't know. But okay, then let's start off. When did you buy it? Well, I think I bought it 25 years ago. Okay, then let's see if we can go online somewhere. And usually you can find the share prices of, and I'll pick a company out of my hat. Let's say you've got shares that you purchased in the Caterpillar Corporation 25 years ago. Let's say in June, 25 years ago, you can go on the website, a website, and you can find the cost basis of those shares from 25 years ago. And I've done that before. I usually have the client do it because it's their cost basis. But usually the 1099-B is going to have the information. Okay, so that's a case here. And so we have the cost. The cost was 6,000 and the sale was 1,000. Again, we have a loss of 5,000. This section right here, you usually don't use many of these, if any, but in your publication 4012, you'll see the various exceptions. Again, there's your dashboard, if you will. And if you've garbled up an entry, remember you've got this icon over here, red in color garbage can, and that would make that particular entry go away, and then you can start over. So again, this is your total gain. And then on your tax return, if your tax return says, hey, I had a $5,000 loss, where's the rest of it? It only shows 3,000. And the answer is the rest of it has carried forward to tax year 2026, and you're going to take a benefit in tax year 2026. And then your capital loss carryover continues going forward until it's used up or the individual passes away. Okay, and then just a quick aside here. You've got capital loss carryover. We mentioned this before. You're going to look at the tax year 2024, and sometimes from tax year 2024, you're going to have a carry forward going into 2025. And this is a screen that you would go to enter data regarding the capital loss carryover from the previous tax year. And then you have to differentiate between obviously short and long term. And then, of course, you also differentiate between the taxpayer and the spouse, or if it's joint. Because keep in mind, when the individual passes away, the loss for that individual then goes away. Okay, so that's where you'd find that carryover amount from 2024, the previous tax year. Sale of a main home, we mentioned this a couple times. This is what I usually do at my site. I usually give this to usually a senior preparer, and then I'll have that taxpayer, that tax preparer who receives the case, if you will, sit with a senior preparer, and then basically there's a tutorial, if you will, and that's helpful because usually this can be pretty intimidating, especially like my volunteers. They're usually students between the ages of about 20 and 22, and they've never purchased a house. They don't know, they don't even know what a settlement statement is. And so usually matching them up helps out. But the sale of a main home, you're usually looking for the settlement statement when you bought it, the settlement statement when you sold it, and then you're looking to the taxpayer for what are called the capital improvements that they've made. And then with that data, you can usually complete the sale of a main home worksheet. Okay, and then Robert, I'm gonna hesitate and see if there's any other questions.
We have a few questions. First question is on the capital loss carryover. Do you have to reduce that amount each year, even if you have no losses to offset?
Let's see, I'll answer your question this way. Your capital loss carryover, what will happen is your software is going to limit the loss to 3,000 and automatically carry over that amount to the next year. And so all you have to do is just make sure that you have the appropriate entries for the disposition of the capital asset, or stated differently, all you got to do is just go to the Schedule D tab and enter that data that we spoke of. And then when you prepare the return that you're preparing, if it's for tax year 2025, you're going to look to 2024 to see if there's any carry forward amounts. And then that's when you go to that tab to enter data regarding the carryover from 2024 to 2025.
We have a question about the 1099 INT. It says there were
Okay.
fields for state tax-free income. Can you tell us what that is?
Yeah, when you have interest that you're earning, sometimes the state of California is not going to tax that interest. So, for example, I think about a month or two ago, I purchased a municipal bond, I think from San Bernardino County, and I'm going to be paid interest on that municipal bond. And on my California tax return, I'm not going to pay income tax on that particular interest. So that's probably what you're looking at.
And then another question says sometimes from a brokerage firm from a capital gain, it says reported or not reported the transaction. What does that mean?
Let's see. I'm going to do this in memory because it's not in my mind right now. Let's see if I can do it from memory. Uh, Robert, no, I can't do it from memory. But
All right.
here's the takeaway. When you're looking at the 1099-B, this is what I do. I review it. If I'm not certain of a particular term or an acronym, I look at the taxpayer and said, okay, and of course, Care Bear language. I said, you're the one who lived it. These are your investment. What does this mean? And a lot of times the taxpayer says, I don't know. And so what I do is I'll Google, there's different websites to Google terms. And every once in a while, I'll call back to the brokerage house and say, what do you mean by this? And I'll be the first to admit there's a lot of stuff I don't know. And so I ask people, hey, what is this? And if I can't get an answer, then again, I'll go right back to the brokerage house.
And then just to clarify, you said that if a spouse has a carry forward and that spouse dies, the carry forward also dies.
That's correct. Your carry forward is used up two ways. You use it up through year after year after year, or once that individual passes away, that carryover amount dies with the spouse.
Only if it's his personal, not a joint, correct?
Oh, yeah, that's true. If you have, and you can own shares as an individual. You hold title as an individual. You can own shares with your spouse, and that means you have jointly owned. But if you own it by yourself, your loss dies with you.
Okay, that's all the questions we have for now.
All right, very good. Okay, let's see. Let me go ahead and jump into another topic. We talked about other income. And I'll be the first to admit this is actually kind of fun. And I know you might thinking taxes are fun, but when you talk to your clients, a lot of times they'll have these small items of income, a couple $100, maybe a couple $1,000. And they go, gee whiz, I don't know what this is. And then once you ask them questions, what I call develop the fact pattern, you say, okay, I know what it is. This is a class action lawsuit and you received a certain amount for what they call lost wages or back wages. And in the IRS publication 525, it's going to tell you what is taxable, what is non-taxable. And this is within the scope of VITA. And so in this particular case, these are lost wages slash back wages. Maybe they were earned back in 2022, but they were paid under this lawsuit in tax year 2025. And so this is an item of income. And so that's where we're going to report this item of income here for, again, the amount received in 2025. Okay, so that's that. And then sometimes you're going to have other income. For example, I've had people at the VITA site where they found something on the beach, and that would have been a coin or a gold ring. They had it appraised, and they retained it. They kept it, and they go, "Hey, what about this coin I found? $2,000 coin or a $4,000 ring?" I'm thinking, well, that's called found property. That's a taxable event. You report that on your return under other income. Okay, and then we're going to go over to now we're going to go over to the itemized deductions, and this is the entries. These are the entries I made. They paid some property tax. They don't have a mortgage, and sometimes you'll have seniors that do not have a mortgage, which I guess is a good thing. But they do pay property tax, and that's going to be reflected on their property tax bill. And then they pay DMV, and again, there's that line, that one line entry that talks about amount that can be deductible for personal property tax. And then just a quick aside, when you're talking about state and local taxes, usually that's not going to be an issue because that's going to be entered already based on your W-2 entry. Okay. And then let's go to the other item we have, and this is the Schedule 1-A additional deductions. Let me show you how to get to that. So here's your federal section. You're going to go down to deductions, and then you're going to go to the tab that says additional deductions. And your additional deductions include these three items. The additional standard deduction for seniors is automatic. You're not going to find a tab for it. So here's your overtime. And then just a quick aside, I am not an expert. I know a little bit about taxes, but this year you're going to see all different types of documents. You're going to see information pertaining to overtime on a W-2. You might have a separate document issued by the company. But the bottom line is, if someone has received overtime, you're looking for a document. It might very well be reflected on the W-2. It might be reflected somewhere else. But once you determine the amount of overtime, you would enter that information right here where it says qualified overtime. And typically, not all the time, but typically it's going to be for wage earners. If it's for someone who's self-employed, then of course that would be down here where it says that 1099 NEC. But again, this is qualified overtime. This is going to be an interesting thing, but for VITA purposes, overtime, usually it'll be reflected on the W-2 or some type of document. And then for tax on tips, you're going to see this a lot. I was just talking to a client yesterday, and she was telling me about her tips. And so you're typically going to see this on the W-2. You might see it on some other type of document, and you're going to have a discussion with your client. Tell me about your overtime, or excuse me, tell me about your tips. And this is where you would include your tips right here, right here. And of course, if it was a self-employed individual, then same concept right here. Okay. And then for our taxpayer, the term is no tax on car loan interest. What it really should say is the car loan interest deduction. So we're going to open that up and you're going to see the heads up display, if you will. And then we go here. This is your vehicle identification number. It'll be reflected on the title. It'll be reflected on that sales document that the taxpayer receives when they purchased it. And then for our purposes right now, our client is taking this deduction for the interest that they paid. If they are self-employed, that's a Schedule C, as in Charlie. If they have a rental property, that's a Schedule E, which we don't do in VITA unless you're military certified. The Schedule F is for farmers and ranchers. That is outside the scope of VITA. Okay, so here is where you would put in that amount right there, the $2,000 of interest. We're going to hit continue. And then we are back to our display. Okay. And then we're going to finish up here, Robert. Let me run through the rest of this. We're going to go over here to the left-hand side. We had estimated tax payments that the taxpayer made, and this is going to be our taxpayer, Lisa. She's self-employed, and she made only one. So let me show you how to get to that. We go to Federal Section. We're going to go all the way down to payments. And then you can see here where you've got federal estimated tax payments made for tax year 2025. And then we have state estimated tax payments made for tax year 2025. And then keep in mind for tax year 2025, that fourth quarter payment will be made by a lot of people on January 15th of 2026. So we're going to open up the 2025 federal estimated tax, and we're going to show you how that works. So you can see she made her payment on June 17th of 2025. And this is something you'll see. You'll see someone who says, "Well, I only made one of my quarterly payments." Sometimes they made two, but whatever they made, you'll plug it in there. And again, I see this more and more at the VITA side because, quite frankly, there's a lot more self-employed individuals that we're helping. Okay, so that's that. There's no state estimated tax payments. And then we're going to go to our medical, i.e. health insurance. Our clients are in the Medicare program, which means they have full coverage, but they're not in covered California. If you're in covered California, you'd indicate yes, and you'd indicate the data that's reflected on the 1095A. So in this case, we're going to say no, and we're done. And then let me just do the quick e-file. When you get things ready for e-file, you want to make sure you have information pertaining to the bank account if they want direct deposit or direct debit. So we indicate e-file. Okay, here's a warning. Great. Get past that. And you'll see something like this. It'll be a little bit different, but something like this. And so you can see the drop-down menu where it says e-file, mail payment. So our choices are we're going to electronically file and mail the payment, electronically file and have a direct debit. In this case, they owe $8. And that's reflected by the blackened font color here and the little minus sign. And so there are the choices. And if they were going to, in some cases, individuals want a paper file. I've seen this before. I encourage them to e-file. They go, no, I want a paper file. No worries. I select paper return, and then I will print out a return for them. I'll give that to them along with the address and say, you want to mail that in by the 15th and make your payment by the 15th. But again, this would be e-file, mail payment, or direct debit. Okay. And then we'll hit continue. You're going to have the demographic data, and it'll look kind of sort of like this. And so you'll look at your 13614C, the intake and interview sheet, and you'll collect that demographic data. Sometimes people don't want to give that data to you. No worries. And so you'll enter all of that data that they give you. And you can see there's a lot. Then you hit continue. And then you'll see something like this, where it'll show the amount of the return. And in this case, they're going to mail the payment, which means a voucher is prepared for them. And there's no state return data, so we don't need to worry about that. And then you come down here, and this is your PIN, personal identification number. And if they select one, great, you can type it in. And if they don't select one, then, excuse me, if they select one, type it in. If they don't select one, then you can type it in for them. Okay, and then down here, this is going to look a little bit different than the actual software you're going to see in about a month or so. But the bottom line is when you're ready, you're going to indicate what is called the return status. And if you're working at my seat, excuse me, at my site, we hot seat it, which means once the individual prepares the return, then the individual physically leaves the seat. We take our quality reviewer, we put them in that seat, and they review the return electronically, and then they indicate it. But this is where you would indicate the return is ready for the review, and then you would save and return. Okay, I think that pretty much takes care of that. So Robert, let's see if I can get past this. I may have to go back. Robert, any questions before we take our break?
So with respect to property tax, is Mello-Roos included?
Mello-Roos, if I remember correctly, boy, I haven't heard that term in a long time. Mello-Roos, what I remember is not included in property tax. Yeah, that's what I remember. And Mello-Roos, it goes back many, many years ago, where developers then essentially shifted the burden to the homeowners. But again, what I remember, it's not considered a property tax.
And then on the no tax on car loan interest, will the taxpayer receive the document only if the car was assembled in the United States? Meaning, does the finance company vet whether or not the car qualifies for this adjustment?
No, I don't think you're going to see the company, the finance company vetting that. That would be the actual sales a sales company, i.e. Ford, Chevy, Tesla, whatever. That's what you're looking at.
Okay, back to the $6,000 for the so senior. Uh, how do we know how much of that was applied to for the taxpayer?
For
As
your
far-
purposes, for VITA clients, that full $6,000 is going to be applied.
Okay. And then if someone utilizes the VITA tax service in a previous year with an IPIN, will that number carry over to this year or will it need to be provided again?
What I remember is the IPPIN is going to be a yearly thing, and so they'll have that yearly letter from the IRS until they're no longer using that.
Okay. And there is a question about the different IRS and franchise tax board payment plans, if you'd be able to go over those. I think we just,
Yeah, just real briefly, for VITA purposes, if they choose to make a payment electronic, then they would go to the website to make payments. If they want to make mail in a payment, they can do that. In some cases, and this is probably just general information, if you have a large payment to the franchise tax board, you want to make it electronically because there are penalties if you make subsequent payments, large payments to the franchise tax board. So the bottom line is the takeaway is make your payments electronically. It's safer, it's quicker, and you don't have to scratch out a check and put a stamp on the envelope.
And does the senior credit apply to disabled senior citizens?
Yes, it'll apply to any senior citizen 65 or older. That senior deduction is going to generate automatically for the purposes of your VITA clients. If you're talking about other clients, there is a phase out based on modified adjusted gross income. All right, so we're going to run through the actual PDF for the Walters that we completed, and we'll mention a few things that you'll see at the site and kind of increase your tax knowledge. So the 8879 is going to be the e-file authorization form. And let me see if I can get to the top here. And so this is going to be the document your taxpayer is going to sign if they want e-filing, which the vast majority of your clients will. And you can see on part one, there's some limited information from the tax return itself. Your clients generally are going to be focused on the amount of the refund, which I don't blame them. I'd get excited too if I'm getting a refund, or the amount that they owe. And you can see on line 5 for these taxpayers, they owe that $8. And then for part two, this is their declaration and signature. And so if you want someone to e-file the return, let me restate that. If they want us to e-file the return, they're going to have to sign this declaration. And you can see where the signature is. And of course, the date has already been pre-populated. And then if it's a married filing joint return, then you would have the spouse sign. And the way I operate at the site when I have a married filing joint couple, I tell them I need signature from both the husband and wife. And sometimes the wife, maybe she's working or the husband's working, and say, "Hey, I'll show up later and I'll sign the 8879." But the bottom line is you want to capture the signature from your clients if they want electronic filing, which most of them do. And then down here, this is your certification. You don't have to worry about this. Your software is going to be completed as far as the entries that need to be completed by your site coordinator or what is called your electronic return originator. You'll have someone designated. Maybe you might even have a backup where you'll have someone who's going to be the actual filer, e-filer, and that's called electronic return originator. All right. And then let's go down to this voucher. This is something you're going to see in the PDF packages that are completed. Sometimes people owe money and there's ways to pay it. Most of the time, people want to pay it electronically, and sometimes they want to get this voucher. And so this voucher is pre-populated. You can see here for Lisa and Robert, they owe a total of $8. It's reflected up here for tax year 2025. And then if they choose to send the voucher in along with their check, they would write the Social Security number on their check and they would send it in for tax year 2025. And then, of course, addresses are important if you're filing, excuse me, if you're paying by voucher. And then this is your address right here. And you can see for California, you can see where it says IRS, Cincinnati, Ohio. And again, I always encourage people, if they can, and a lot of people are able to do it, to go on the website and pay electronically. I had one of my clients, she's I think 81 or 82, and I said, "Okay, here's your voucher, unless you want to pay electronically." And she said, "Yeah, sure, I can do that electronically," and she did. And so I figure if an 80-year-old woman can pay electronically, I'm thinking most of us can probably do that. But again, it is a preference if you want to pay with a voucher and a check. Okay, let's get to the 1040 SR, and this is for your seniors, which means it's more lines, if you will, or a larger font. But again, the software is going to either complete a 1040 or a 1040 SR based on the age of the taxpayer. And you can see here, this is larger font, certainly in the filing status. And then this looks a little bit different from last year for the dependent section. Our taxpayers don't have any dependents. And then we have total for our taxpayers, we had taxable interest on line 2B. We had Social Security benefits, and you're going to get a question on this from seniors. They're going to say, wait a second, I thought Social Security benefits were not subject to tax. And the answer is, it depends. And for our particular taxpayers, based on their income, a small portion is subject to taxation, and that's reflected on line 6B. This is the amount of that capital loss that they suffered or had, $3,000, and they're able to enjoy that loss for tax year 2025. And then the $2,000, the difference is carried forward to tax year 2026. And that's why it's really important when taxpayers come to the site. We certainly want to build a rapport with them. We want to put them at ease. We're there to help them. But we are going to ask them for tax documents. We're also going to ask them for their previous return. Now, sometimes they're returning clients, and so their previous information is going to be in our software, but a lot of times they're going to have their previous return, both federal and state. And additional income, we'll show you that in just a moment. Total income is going to be all those lines from 1 all the way through 8. And then when you see AGI, that simply means total income less an adjustment to income. And we'll talk about this 954. This is the 1/2 self-employment tax deduction that you're going to see on the return. All right, and then their AGI carries forward to page 2, if you will, or line 11B. This on line 12E is their standard deduction amount. This includes the deduction for 2 individuals, married, filing joint. It includes the additional amount for the taxpayers, and that is because they're seniors, and also the additional amount because our taxpayer husband is blind or meets the legal definition, or I should say the tax definition of blindness. Okay, and then line 13B, this is the additional deductions here on line 13B. And then you can see our taxable income is actually, it's actually 0. And so this is good. And with no taxable income, they don't owe any individual income tax. But because she's self-employed, she owes self-employment tax. And this is something you may have to explain to someone. Usually it's going to be younger adults who are not familiar with the tax system. And they go, why do I have to pay self-employment tax? And the answer is that's easy. Congress passed the law about 70 or 75 years ago. If you're self-employed, you generally have to pay self-employment tax in addition to individual income tax. Okay, and then this is the amount of the withholding, and that would be from their Social Security documents. And then you might remember she made an estimated tax payment because she's self-employed, and that was a federal estimated tax payment of $400, which is reflected on line 26. So total payments are 1,900, and the difference between what they owe and their total payments is $8. And that's what they would pay. Typically, they would pay electronically, or again, we talked about the voucher. If you do have an individual who has to mail in their return, this is important. Typically, your site coordinator is going to handle this, or maybe your electronic return originator. But if you say, hey, we can't e-file for you because of whatever reasons, go ahead and make a copy and send in your return. Tell your client, sign the return. In this case, this would be on this area right here that says your signature. If it's a joint return, you both want to sign. If you're signing and you're sending in a copy, and then obviously they want to retain a copy for their records. All right, this is your senior deduction chart. This is great for taxpayer education. And individuals say, why am I entitled to this large standard deduction? Well, if you're a senior, you get an additional amount. If you're blind, you get an additional amount. And so that's where that standard deduction chart appears right here, all done automatically. All right. And then let's go down to our next page. This is Schedule 1, additional income and adjustments to income. And so you can see the Schedule C net income amount. And net income is defined as gross receipts less your ordinary and necessary expenses. And then we come down here, And we can see the lost wages or back wages, if you will. And that's another thing you're going to see in any industry. You have different terms to describe the same thing. Kind of like the automobile. Some people use the word car. Some people use the word horseless carriage. Some people use the word automobile. You're going to see different terms. So lost wages, back wages, same thing. There's our total on line 10. And then our adjustments to income. This is something you're going to see a lot of in the VITA program. You're going to have people who have educator expenses. They're high school teachers, something like that. You might have someone who has, in this case, they're self-employed and they can take what is called one half self-employment tax deduction. And that appears on line 15, done automatically. You might have somebody who has penalty and early withdrawal of savings. You might have someone who's been divorced for 10 years and they're paying alimony and they can take an alimony paid deduction because they qualify for that. You might have someone who has student loan interest and that's reflected on line 21. Whoops, sorry about that. Line 21. So again, this is, go to the top here, adjustments to income. You're going to see a lot of this. And then just a quick aside, and I made this mistake one time, and I gathered all the information from a individual who's divorced, with the exception of the recipient's Social Security number. You're going to need that to enter that into the software. Jury duty pay, and this would be the adjustment for a jury duty pay where someone relinquishes their check to their employer. Okay, we're going to go to the next page. These are additional deductions, and this is the one we'll spend a little time with this. And if we don't get to the second scenario, so be it. But we're going to get something out of this. This is the form you're going to see a lot of because a lot of taxpayers get tips. There's a lot of, I was just talking to a taxpayer yesterday who had not only tips but also overtime. And so you're going to see this. And so this is an example where the software is going to calculate the so-called no tax on tips. Of course, there's a limitation, and that's part one. And you can see right here, we don't worry about the phase out. The phase out is outside of the scope of VITA. But if you're one of these people making $200,000, $300,000 and you're single, well, then you're going to get phased out. But again, in the VITA program, we don't worry about that. That's line 9. Here's your total amount right here. Again, you're going to enter the data into the software. Software is going to calculate this particular deduction called the so-called no tax on tips. And you're also going to get feedback because sometimes you might have someone who's highly compensated in tips. Maybe they received $30,000 in tips and maybe a small modest income of maybe $50,000 total. And they're going to say, wait a second, I thought all my tips were not subject to taxation. And you're going to say, well, that's the mantra that you saw in the media. This is the actual law. There's a limitation on the so-called no tax on tips. And then the no tax on overtime, same situation. There is a limitation, and you can see right here the limitation is 12,500. So if someone received overtime greater than that, again, there's a limitation. And for VITA, the so-called phase out is well beyond the scopes, and so this is not going to worry. We're not going to be concerned about this regarding our VITA client. But if you're a highly compensated individual and you're receiving overtime, there's a limit. There's a limit to that based on your modified adjusted gross income. And then this is the so-called no tax and car loan interest. Don't know who came up with it. Very confusing term, but basically an additional deduction if you purchase an automobile that qualifies. And someone had mentioned, is it assembled in the United States final assembly? Is it under 14,000 pounds gross weight? Is it a new vehicle? And so you're going to capture that information from your client. You also capture the vehicle identification number. And last time I looked, it's on a title and it's also on that long document that you receive from the car dealership when you purchase a vehicle. So in this case, they paid interest. And then sometimes people say, well, I paid my car loan of $400 a month. Your car loan typically is a fully amortized thing, which means that $400 payment, a portion is interest and a portion is principal. We're interested in interest, which we have captured here, that $2,000. And so we've got that $2,000 deduction for our taxpayer. And then let's see. And so you can see we had and here's the additional amount. The additional amount for our seniors, we have two seniors here, the wife and the husband, and they get that additional 6,000, and that's called the enhanced deduction for seniors. And this is above and beyond that standard deduction they receive. So this is a great deduction for your seniors, your VITA seniors. Now, of course, for VITA, we're not worried about this limitation, but there's a limitation for individuals who are receiving a higher AGI, if you will. So again, here's our deduction: 6,000 for the wife, 6,000 for the husband, plus that $2,000 for the interest, which gives them the additional deduction of 14,000. And then Robert, I'll hesitate, see if anybody has a question.
There is a question. Do tips have tax brackets on them similar to other income? Example, total of 1,000 in tips is first 500 is taxed at X amount, and then the next 500 is taxed at Y amount.
Uh, Short answer to that, when you receive tip income is subject to ordinary income rates. And so that's really probably the answer for you there. And then also when you receive tip income, whether it's $1 in tips or $25,000 in tip, your tip income is subject to income tax. And then, of course, you also have to pay what is called uh, FICA tax on your tip income. Typically, not all the time, but typically your tip income is going to be reported or what is called run through the W-2, which means you're going to report tips to your employer. Your employer is going to account for that on the form W-2.
That's it. That's all the questions we have now.
Okay, great. Let's go. Let's bounce down to our next one. Additional taxes. This is something you're going to see a lot of, and you're going to have individuals. And this is something for the excess advance premium tax credit repayment. This is for individuals in covered California, and they received too much of a subsidy. This is it gets very emotional. People sometimes get confused. I think I mentioned I had about a client. She had to pay back like $4,000. It was a lot of money for her. And I explained to her that she'd received too much of subsidy during the year. And the takeaway is if you're in covered California and something changes in your life, you want to go back to covered California and make sure those changes are reflected because your subsidy is based on a number of factors, i.e., the income that you're making, whether you're married or not, whether you have kids or not, where you live. And so the takeaway is go back into covered California, especially if you received a pay raise, because you want to avoid this excess advance premium tax credit repayment. That's a bad thing. All right, let's see if they have anything else. They do. Self-employment tax. This is calculated automatically, and for our purposes, we usually don't do anything with this. There are certain taxpayers which you probably won't bump into that are not subject to self-employment tax, even though they are self-employed individuals. Typically, this is automatically calculated, and we don't do anything with that. All right. Other taxes, usually you won't see this, but again, you have individual income tax, and there are different types of taxes. Usually in the VITA program, individual income tax and self-employment tax. Okay, we're going to mosey on down here. Itemized deductions, we already know the taxpayers took the standard deduction. The Schedule A will be automatically generated in the PDF file, and the software is going to take the greater of, and that's what we do in the VITA program. But you can see that the Schedule A has been populated, but we know the standard deduction was greater than the itemized. And you'll see probably maybe about, I think the last time I looked, maybe like 9% of our taxpayers itemize their deductions because the standard deductions were doubled under a law that came out about 7, 8 years ago. Okay, so that's that. And then just a quick aside, I mentioned a couple weeks ago, you have a lot of taxpayers for whatever reason. I'm not making any judgments. They gamble. I gamble. I don't gamble every day. I think I gamble like maybe twice a year in Vegas. But individuals, when they gamble, if they have winnings, they have to report it on their federal return. If they have losses, they can take losses on their itemized deductions as Schedule A up to their winnings. So you might have someone who has gambling losses, and you'll enter that into the software. Your interest in dividends, we've already talked about interest. If you have someone who is in a credit union, the credit union may call the interest that they pay to their shareholders, they may call it dividends. It's really interest. When you are a shareholder in a corporation and the board of directors has issued a dividend and they paid a dividend, that's a dividend. It's different than interest. So we have interest income here. And then dividends, if they had any, would be there. Your 1099 DIV is going to report what is called ordinary dividends. You also have what is called qualified dividends. You simply key it in the software, and sometimes you'll have a 1099 DIV that has ordinary and qualified dividends. Just key it, and your software is going to calculate the appropriate tax. This is just taxpayer education. You're going to see this every once in a while. We don't do what is called a report of foreign bank and financial accounts reporting. We don't do that. If someone has a foreign bank account, then they have to report to the United States Treasury that they have a foreign account, where the account is, and the balance in that account. Now, if you're certified on the international module in VITA and someone has interest income they receive from a foreign bank, then we can help them out on the return. But I got many a client in my private practice who have bank accounts, you name it, they've got it. They've got it in Croatia, they've got them in Russia, they've got them in Korea, Mexico, all over the place. And what they have to do is they have to do a treasury reporting. It's called a FBAR reporting, which is the report of foreign bank and financial accounts. And Robert, I think I saw some questions. Anything? Are you there, Robert? All right, then we'll move on. Okay, Schedule C, you'll see a number of these. And when you have a Schedule C, we've already made the entries regarding the income and the expenses. And these are usually not a really difficult thing. It's usually kind of easy breezy, if you will. But what you have to do is you have to make sure that the taxpayer tells you that fact pattern. What are the gross receipts? And sometimes, again, reconstruction is going to be completed by the taxpayer. Uh, you're going to have uh, you're going to have a lot of different types of expenses, and sometimes they'll have it listed on a piece of paper. Sometimes they may verbalize it, and when they start verbalizing it, say capture that on a piece of paper, and then sometimes we may have to have a brief discussion. The one discussion I typically have is with the cellular phone. And I ask questions regarding, do you make a flat payment? If you make a flat payment, you don't get an itemized list, then you're not going to be able to deduct that cell phone on your Schedule C. But you can see in part two, these are all of the titles. This is what we call the chart of accounts, if you will, but basically the title of the particular expense. And you'll have supplies expense, maybe some travel, things like that, office expense. If you have vehicle expense, there's a separate tab for that. And we mentioned that you have to have an accounting for the business miles. And reconstruction is okay. When I was an IRS agent and taxpayers didn't have their number regarding, I should say their substantiation regarding their vehicle expense, we would conduct a reconstruction. And since they lived it, they worked it, they can do the reconstruction based on a calendar and maybe their notes and maybe even their memory. You're going to get this question a lot. People say, I've got a home office. You say, okay, very good. We don't do the home office deduction in the VITA program. That's outside of the scope. And so they'll have to go to a paid preparer. capital gains and losses, you'll see a lot of this because even though we work with low and moderate income taxpayers, a lot of people have mutual funds, a lot of people have, they have stock, and so you're going to see disposition of capital assets. Typically, your capital assets that are disposed of are going to be stocks and bonds. But if someone has purchased, let's say, a motorcycle, and they say, "Yeah, I bought a motorcycle and I put a few, pipes on it, and then I sold it, and I actually had a gain." It's possible. Well, the motorcycle is also a capital asset. You would go through that fact pattern to determine if you have a gain or loss, and you make your appropriate entries in your software. Okay, so here's your short term is on the very top. This is a schedule D as in Delta. And so your software is going to differentiate or segregate the short term and the long term gains and losses. And in our particular case, we had a long term. And I'll just point this out down here in part two, long-term capital gains. And it says here $5,000, and this is the total loss. And so we know that the software is only going to allow $3,000 of the loss for tax year 2025 and carry forward the other 2,000. And then just a quick aside here, let's go back to the short term, and you're going to see this line that says carryover. Well, when you have that carryover, that's when you make those entries. It's going to be reflected here on line 6 for short term, and then down here on line 14 for long term. So again, you differentiate or you segregate your short and your long term. And the reason that's done is because your long term gains are taxed at preferential rates. And I think we mentioned this before. Sometimes you'll see a taxpayer in the VITA program that has capital gains and they're long term and they don't owe any individual income tax. And that could be because the long-term capital gains tax rate starts at 0%. So you may see that from time to time. Next page, that's that $5,000 that we talked about. And then it also shows the limitation. The limitation is 3,000. So that means, again, carry forward of 2,000 going to tax year 2026. And then this is the 8949, and this gives you detailed information regarding the disposition of a capital asset. And again, you're going to do what you're going to do based on your guidance from your site coordinator. At my site, we go through aggregation. We aggregate short and long term, and that way we're not sitting there and entering data in the software for 3 hours. I think I mentioned to you, I had a client one time that wanted me to do that. And I told him it'd probably take about 8 to 10 hours because he had thousands of entries. And I told him I'll charge him accordingly. He has to pay me in advance. And he goes, "Well, what's my other option?" I said, "Aggregation." He goes, "Do it." And I did it in a matter of minutes and we moved on. Here's the self-employment tax. This particular form sometimes confuses people, but the bottom line is when you have net income, then what you should tell yourself, the self-employment tax is approximately 15% of net income. And so this calculates our bottom line down here, which is line 12. This is the self-employment tax on our net income that we had for our taxpayer. And then the 1/2 self-employment tax deduction is reflected on line 13. Again, done automatically. This is new. I have not seen this on the VITA software, and so you have a comparison. I guess that's helpful. Of course, each year stands on its own. And then this right here, this is, as it's titled, Qualified Dividends and Capital Gains Tax Worksheet. And so you have to keep in mind, if you have a long-term capital gain or a qualified dividends, it's taxed at preferential rates, which is a good thing for the taxpayer. And this particular form then would do that for you.
Jerry, I have a question about what is the difference between ordinary and qualified dividends?
Your qualified dividends, for lack of a better term, it means that the taxpayer is invested in a corporation and the dividends have been paid out, and there's certain requirements. I guess that's the best way to put it. I can't give you a precise answer, but there are certain requirements that are met by the corporation. And then once that happens, then they're deemed to be qualified dividends. This is the important thing to remember. The 1099 DIV is going to separate or segregate, if you will, ordinary and qualified. All you've got to do is key it as you see it from the 1099 DIV. Anything else, Robert?
We have a question. It says, uh, why don't we see the $2,000 carryover on line 14?
Line 14, the carry. Let's go back. Try not to make you too dizzy. And you're referring to the schedule D as in Delta. Okay.
It's, oh, I see. She's wondering why that $2,000, because it's for next year, not this year.
There you go. There you go. Let's go to, I think we have a separate sheet here toward the bottom, toward the end of our document. So let's go to that without making you too dizzy again.
And then there's a question, I'm going to read it exactly as it's written. It says, can we carry over the Medicare premium insurance from W-2 and/or SSA 1099 to Schedule C self-employed medical insurance premiums as an expense on Schedule C?
I think the short answer to that question is no.
Okay.
All right, let's go to, here we go. So this is what you'll see, and this is one of your go-to documents from certainly your previous year. Now, this is a work in progress. So it says right here, you use the worksheet to figure your capital loss carryover from 24 to 25. We're in the 2025 software. So what it'll say once it's released, i.e. the software we're going to be using, it'll say from 2025 to 2026. But you kind of get the idea. This is what you're looking for. You're looking for the worksheet. Your taxpayer is looking for the worksheet to carry forward to the next year. So we're in 2025. This worksheet that you give to your taxpayer along with the PDF document will have, again, the carry forward to 2026. So that's what it's going to look like, something like this. But again, this is a work in progress. This has not been perfected. This is the practice lab. Okay. Let's see. Here's your Social Security. I get this all the time from seniors, and they go, Jerry, I thought my benefits were not taxed. And think of, well, for a lot of taxpayers, they're not, but it depends. It depends on your income, threshold amount. And so this particular worksheet shows how the Social Security benefits are taxed in part. And I actually had a certified public accountant one time says, Jerry, I don't understand this. I said, well, no big deal. Just go to this particular worksheet and you can explain to your client why a portion of the benefits are subject to taxation. You just go through the worksheet and that's all it is. And you can see at the very bottom, taxable Social Security benefits, line 18, and that's the amount subject to taxation. And then sometimes for this year, you're going to get pushback, and people say, well, I thought that the media said there's no tax on Social Security. Well, you can turn that around in a good way and say, well, what the media was trying to tell you is there's an enhanced senior deduction, and that enhanced senior deduction, if you meet it, and you probably do, it's $6,000 per senior. And we already talked about that. Okay. All right. So that takes care of that. Robert, questions before I bounce to my PowerPoint?
How much other income is allowed before Social Security is taxed?
Let's see. I'll answer the question this way. There's a threshold amount for a single individual is 25,000. For a married filing joint, I recall it's 32,000.
And that's all the questions we have.
All right. So we're going to go ahead and go to our PowerPoint, and then we'll just open it up to questions and see if anybody has one. Let's see here.
And then
Okay.
I have Fred wants to say a few words. Go ahead and unmute yourself, Fred. Can you unmute yourself, Fred?
Yes,
There you
I
go.
did.
There you go.
Thank you very much. Okay, in behalf of St. Killian VITA, we would like to thank all volunteer for their attendance to this St. Killian Orange County United Way uh, combined Zoom VITA training. We hope it's been a good learning training experience to everyone. And of course, now the next step is to certify and pass the test through the Lincoln Learn. Typically, the deadline to certify is 15 January. And should there any more time needed, please let us know, and we can work something else. As, to get to our St. Killian VITA team, you should at least pass the 10 ethics questions first, and then continue on if you are going to be a tax preparer uh, to the basic and advanced. So we encourage the St. Killian to at least get the basic, and of course we would like to have everybody as much as possibly to certify advanced. Should you need any further assistance, information to all St. Killian VITA will be disseminated as far as point of contacts who will be able to address those informations. Primarily right now is Mel, Robert, I, Adela, John Nagy, and so forth. But those information with their phone number will be disseminated to everyone shortly thereafter by Robert. And
Thank you, Fred.
yeah, and foremost, it's been a great time, and thank you all for volunteering and attending this worthwhile training. Have a happy holiday, and thank you all.